Imagine you're staring at a stock chart, right? And the line is practically vertical.
Yeah, the kind of chart that makes you refresh the page to make sure it's not a glitch.
Exactly. I mean, we're talking about a company whose stock is up a mind-bending 12,267% since the start of the year.
Which is just staggering.
It really is. It's riding the absolute crest of this massive AI infrastructure wave. But there's a catch, and it is a massive one.
Oh, yeah. A lot of red flags.
Right. Analysts are flashing warning signs, company insiders are aggressively dumping their own shares, and fundamentally, the business itself isn't actually turning a profit.
Actually losing money faster than they were a year ago.
Exactly. So what are we looking at here? I mean, is this the ultimate misunderstood, undervalued AI darling of the decade? Or are we staring straight into the jaws of a massive retail-driven value trap?
Well, it really is the defining question of this current market cycle, isn't it?
Oh, absolutely.
We're constantly trying to figure out exactly when the promise of, tomorrow's transformative technology completely blinds us to today's harsh financial reality.
Right.
And with this particular company, the disconnect between those two things is, well, it's historic.
It is. And that is exactly what we are exploring today. We are doing a deep dive into AXT Inc., trading under the ticker symbol AXTI.
AXTI, right.
And just for context, so everyone is on the same page, today is April 13th, 2026. As we're looking at the data right now, the stock is currently trading at $62.13, which is actually down about 3.47% for the day.
Just a little intraday pullback.
Right. But before we jump into this incredibly wild ride, a quick reminder for you all. Make sure to like the video and subscribe to our YouTube channel, and compulsory leave a comment with your feedback. We want to know what you think of this setup.
Yes, please do. And crucially, before we get into the weeds here, I need to make one thing absolutely clear.
Oh, the disclaimer. Always important.
Very. What we are doing today is an impartial analysis of the provided data, the market sentiment, and the underlying financials. This is an exploration of information and mechanics. Absolutely no financial advice is being given here.
Right. None at all.
We're just analyzing how this ecosystem functions, not telling you what to do with your portfolio.
Okay, let's unpack this. Our mission today is to dissect AXT Inc.'s financials, pull apart their technicals, and track this really aggressive insider activity. We need to figure out if this is a genuine foundational AI infrastructure play or if it's just a dangerous bubble. And to understand how a stock runs up 1,200% in a matter of months, you really have to understand the narrative.
You do, because nobody is buying AXT because they have, a slick new chatbot.
Right, no. They are buying the physical building blocks of the AI revolution.
Exactly. So AXT is a dominant supplier of indium phosphide, or NMP.
NMP, got it.
Yeah, and this is a highly specialized semiconductor substrate. When you think about artificial intelligence, you have to think about massive data centers, right? Packed with tens of thousands of GPUs.
The hardware keeping everything running.
Right.
Yeah.
And those GPUs have to talk to each other, and they have to do it with incredibly low latency. Traditional silicon actually struggles with this because silicon doesn't emit light efficiently.
Oh, interesting.
But indium phosphide does. It is the critical foundation for the lasers and optical transceivers that allow these AI clusters to move massive amounts of data at light speed.
Okay, so the bullish catalyst here, the real why behind the hype, is that as tech giants build out these trillion-dollar AI data centers, the demand for indium phosphide is going to absolutely skyrocket.
Exactly. They cannot build the infrastructure without this material.
And the projections really reflect that optimism. I mean, we are looking at a projected 2-year revenue compound annual growth rate of 42%.
Or 42% CAGR. I mean, that is the dream scenario.
Yeah.
That is the kind of forward-looking narrative that completely alters market psychology. It makes a stock go parabolic.
Totally.
The market is pricing in a future where AXT just corners the market on a material that the biggest tech companies in the world literally cannot function without.
Well, that's the theory anyway. But when you pull the 2025 income statement, that theory falls apart incredibly fast.
It's rough.
As the voice of reason here, I have to say, the reality check is brutal. They aren't moving forward. They are actually moving backwards.
Yeah, the numbers don't lie.
While the stock was up over 1,000%, their actual total revenue shrank. They dropped from $99.4 million in 2024 down to $88.3 million in 2025.
Which is wild when you think about the narrative.
And the bottom line, their net loss practically doubled, widening to negative $21.3 million. Earnings per share over the trailing 12 months is sitting at negative 49 cents. Literally every metric you'd want to see growing is shrinking, and every metric you want to shrink is growing. It's like a trendy new restaurant with a line around the block. But they are somehow losing $2 on every single meal they serve.
That's a great way to put it. And it's not just a top-line problem. When you dig into the cost of revenue, you see the real bleed. Their gross margins got cut in half.
Wait, really? In half?
Yeah, dropping from 24% down to just 12.7%. And when you see margin compression that severe in a high-demand tech sector, it usually points to a fundamental breakdown in manufacturing efficiency, or just severe raw material cost inflation.
Right, because if indium phosphide is the holy grail of AI data transfer, they should have immense pricing power. Like, they should be commanding a premium.
Exactly. They should be making money hand over fist. But growing indium phosphide crystals is notoriously difficult. The manufacturing process requires intense precision.
It's not just stamping out widgets.
No, it's not like stamping out metal parts. The yield rates, the amount of usable material you get from a production run, they can fluctuate wildly.
Oh, I see.
If they're trying to scale up rapidly to meet future AI demand, they're likely dealing with high defect densities and basically having to scrap a massive percentage of their product. So they're selling more volume, perhaps, but it's costing them exponentially more to produce it at the required purity.
So it's like buying a lottery ticket that's already been scratched off, hoping the numbers magically change because it was printed on really fancy paper.
Basically.
I mean, their operating margin over the last 12 months is negative 24.9%. The more they operate, the more money they lose.
And what's fascinating here is how the market is completely ignoring that current, very real operational bleed.
Completely ignoring it.
To figure out how long they can survive this scaling phase, we have to look at the balance sheet.
Mm-hmm.
And admittedly, it is the one area where they have a buffer.
Okay, some good news.
Yeah, they are sitting on $433.8 million in total assets against only $99.1 million in total liabilities. Total equity is a healthy $334.6 million.
And they have cash. $120.3 million in cash and short-term investments.
Yeah.
So, I mean, they aren't going bankrupt next Tuesday. They have a runway to try and fix these manufacturing yields.
They do have a runway, but the cash flow statement shows you exactly how fast they are burning through it. Cash from operations for fiscal year 2025 was negative $12.8 million.
Wow.
They are burning the furniture to keep the house warm. The market is looking right past the 2025 losses and pricing the company entirely on its future AI infrastructure potential.
But here's the crazy part. If the fundamentals are this broken, the stock chart is living in an entirely different universe.
A parallel dimension.
We have to pivot from the fundamental analysis to the technical momentum and order flow because the 52-week range on this stock is absolutely staggering.
Unbelievable.
This time last year, AXT was a forgotten microcap penny stock trading at a 52-week low of $1.13.
Just over $1.
Right. And it recently hit a high of $71.49. It now commands a market cap of $3.45 billion.
Going from $1 to $71 in a single year changes the entire psychological profile of an asset. It stops trading based on earnings and starts trading entirely on momentum, liquidity, and sentiment.
Yeah, fundamentals go out the window.
Exactly. Just since April 6th, we've seen a massive 52% surge in a single week.
It's pulled back slightly to 62.13 today, but the technical levels are vital if you are trying to understand where this might find a floor.
Right, the support levels.
Key short-term support currently sits at the 50-day simple moving average, which is down at $52.26. The 200-day moving average is right below that at $50.70. And if the bottom truly falls out, major long-term support is way down at $35.36. On the flip side, primary resistance is at $74.65. That is the ceiling it needs to break to keep this parabolic run alive.
And when you look at the momentum indicators, the tension is just extreme. The MACD is at 3.84. You've got that bullish crossover indicating the short-term trend is still forcing its way up.
Pushing.
But with the 14-day RSI pushing 63.43 on a stock already up 1,200%, the momentum is incredibly stretched. We are dangerously close to overbought territory in an environment where the air is getting very, very thin.
And a massive amount of that upward pressure seems to be coming directly from retail options traders.
Oh yeah, the options flow is wild.
We are seeing a huge, sharp uptick in short-dated call options, specifically the April 17th $60 calls. Retail is aggressively buying the right to purchase the stock at $60, basically betting the house on an immediate, violent breakout.
And this is where market mechanics supersede the underlying business. When retail traders buy that many out-of-the-money call options, The market makers who sell those options have to hedge their own risk by buying the underlying stock.
The classic gamma squeeze.
Exactly. The options market literally forces the stock price higher, regardless of what the balance sheet says.
But there is a massive counterforce building. Short interest is currently sitting at 14.11% of the float. That is 7.18 million shares sold short.
That's a lot of conviction from the bears.
And that short interest recently jumped by 16.42%. So if you are holding AXT right now, you really have to ask yourself, are you holding it because you genuinely believe they will corner the market on indium phosphide? Or are you just playing a highly dangerous game of chicken with institutional short sellers?
It is the ultimate game of chicken. You have retail traders fueled by FOMO trying to force a squeeze, while institutional short sellers are looking at the negative 24.9% operating margins and bidding that gravity is inevitably going to take hold.
Right.
It creates a literal powder keg of volatility.
And when you have retail traders aggressively buying call options at the absolute top of a 1,200% run, it is always illuminating to look at what the professionals are doing.
Oh, this is the best part.
Look, I get the retail hype. The AI narrative is seductive. But then I check the professional analyst targets. The overall consensus is just a hold with 2 buys, 2 holds, and 1 sell.
Which is pretty lukewarm for a stock up this much.
Yeah, but the rating isn't the shocker. The average price target is $22.80. The stock is at $62. Are the analysts just totally missing the AI boat here, or is retail blindly walking off a cliff?
Well, analysts model cash flows. They don't model memes.
That is so true.
That $22.88 average target implies a 64.47% downside from current levels just to reach professional consensus.
A 64% drop.
Yeah, even the absolute highest analyst price target on Wall Street right now is only $35. That tells you that the institutional side of the market believes the price action is completely detached from any rational valuation metric.
And here's where it gets really interesting. You can argue that analysts get things wrong all the time, right?
Sure they do.
But what about the people actually building this company? Because while retail was aggressively buying those $60 call options in March 2026, the executives at AXT were doing the exact opposite.
The insider selling data here is impossible to ignore. I mean, in March, while the stock was surging between $36 and $51, the CEO, Morris Young, the CFO, Gary Fisher, and a director, Jesse Chen, sold a combined $43.3 million in stock.
$43.3 million. Now, I know the common defense. Executives sell stock all the time to pay taxes or buy a house or whatever.
Yes, but you do not see 3 top-level executives systematically dump over $43 million worth of stock into a retail-driven rally just to pay a tax bill.
No way.
That is heavy, aggressive risk offloading.
And here's the kicker. Over the last 3 months, there were 0 insider buys.
Done.
Not a single executive reached into their own pocket to buy a share of this company while the retail market was furiously buying up call options.
If we connect this to the bigger picture, it sends a chilling signal. When the CEO and CFO navigate their own ship, they know the reality of their supply chain. They know exactly what those manufacturing yields look like.
They see the real numbers.
Right. If they truly believed this company was at the ground floor of becoming a $10 billion AI titan, they would not be cashing out tens of millions of dollars at $40 a share.
Yeah.
The lack of internal conviction that these price levels are sustainable is glaring.
It really brings us to the great debate. We have 2 entirely different realities colliding here. We have the undeniable future demand for indium phosphide in AI optical networking.
Which is very real.
Right. And then we have shrinking revenue, negative margins, a $22 price target, and massive insider dumping. So is this simply an undervalued opportunity going through some temporary growing pains, or is it a massive trap?
Let's quantify just how massive the valuation gap is. The GF value, which is an intrinsic value estimate based on historical multiples and future business estimates, is sitting at an astonishing 2.32 cents.
$2.32.
Yeah, that suggests the current stock price is trading over 2,600% above its intrinsic value. And the forward PE ratio, it's completely non-existent. It's calculated at negative 131.5 because they simply do not have the earnings to support a multiple.
But to be fair to the bull case, why would someone hold this stock with deep conviction right now? Like, what is the best case recovery scenario where this $62 price tag actually makes sense?
Well, the bull case hinges entirely on flawless future execution. If AXT can successfully resolve the extreme difficulties of manufacturing indium phosphide at scale,
A big if.
A huge if. And if they can secure massive long-term contracts with the major data center builders, if they can actually realize that 42% projected revenue growth, and most importantly, turn those negative margins positive.
Then the current price could be justified.
Exactly. In that absolute perfect storm scenario, paying a massive premium today could be viewed as getting an early entry into the monopoly supplier of the AI revolution's most critical hardware.
That's the dream. But I have to counter with the bear case, because the risks here go far beyond just fixing a factory line. The worst-case continuation lower isn't just about bad margins, it's about existential geopolitical threats.
Right. This is the critical why behind the downside risk.
Yeah. Exactly. Indium and gallium, the raw materials required to make these substrates, are overwhelmingly controlled by China.
Oh, yeah.
We are already seeing intense regulatory risk and uncertainty surrounding China's export permits for these critical minerals. If geopolitical tensions flare up, or if China decides to weaponize its control over the supply chain and restrict exports, AXT's entire revenue projection doesn't just dip.
It evaporates overnight.
Right, it's gone.
And when you combine that severe external geopolitical vulnerability with the internal reality of a negative 24.9% operating margin, the foundation of this $3.4 billion valuation looks incredibly fragile.
The bear case is that the options-driven momentum simply exhausts itself. And when momentum snaps on a stock that has negative earnings and severe geopolitical overhang, the fall isn't gradual.
It's a cliff.
It's violent. The stock could easily crash straight through its moving averages and plummet back toward that major support level at $35, just wiping out billions in retail wealth.
Which highlights exactly why retail traders constantly get trapped in these scenarios. The psychology of a momentum-fueled value trap is intoxicating.
It really is.
They see the ticker symbol associated with AI infrastructure, they see a 50% weekly gain, and the FOMO takes over. They buy near the absolute top, totally ignoring the fact that the actual business is shrinking and the insiders are fleeing.
And then, when the options expiration hits, the market makers unhedge, the short sellers pile on, and the volatility just crushes them. The stock violently reconnects with its actual fundamental value.
Yeah.
It's basically a wealth transfer from impatient retail buyers to patient institutional shorts and cashing out executives.
Precisely. Which means we have to separate the short-term outlook from the long-term reality. In the short term, over the next few weeks, AXT is going to remain highly, highly volatile.
For sure.
The daily price action is going to be driven almost entirely by options flow, retail sentiment, and this ongoing war with short sellers.
Yeah.
It is completely untethered from its balance sheet right now.
But in the long term, gravity always wins. A stock cannot outrun its cash flow forever. The long-term outlook is 100% dependent on execution. Can management stop the cash bleed? Can they turn that 42% projected growth into actual bottom-line profit? Because if they can't, this valuation will inevitably collapse.
And we won't have to wait long for the market to demand proof. The ultimate catalyst is right around the corner. Q1 2026 earnings are officially scheduled for release on April 30, 2026.
That print is going to be the moment of truth.
Oh, absolutely.
Yeah.
Will the numbers finally start to match the AI narrative, or will the gross margins continue to compress?
So what does this all mean for you? As we said at the top, this has been an exploration of the underlying mechanics, the conflicting signals, and the intense market psychology surrounding an explosive stock.
We aren't telling you to buy, hold, or sell.
Not at all. We are just giving you the context to look past the hype and understand the actual machinery moving the price.
And as you take this information and continue to dig into the sources yourselves, this raises an important question. We are witnessing a technological shift with AI that many compare to the Industrial Revolution.
Right.
If the AI revolution truly requires AXT's specialized indium phosphide to function, does traditional valuation even matter right now?
That's a great question.
Are the old metrics of PE ratios and cash flow simply broken in the face of this kind of paradigm shift? Or are we just watching a $3.4 billion game of musical chairs and the music is about to stop?